So ladies and gentlemen, once again, very good morning and welcome to the second day of Asia Pacific Precious Metals Conference. We'll start the day with the masterclass. The topic of the masterclass is Role of Gold in Investment Portfolios. And to give us insight, we have two speakers. Let's welcome first and foremost Mr. Alistair Hewitt, World Gold Council. Welcome, sir. And also joining him, we have Mr. Bart Malik, Global Head of Commodity Strategy, TT Securities. Welcome. And ladies and gentlemen, please take a look at slido.com and the code is APPMC 2019 for your questions. Thank you. Let's welcome both of them once more. Thank you.
Good morning. It's a pleasure to be here at the third Asian Pacific Metals Conference, and it's an honor to be here for the 25th anniversary as well. So thank you very much for inviting us here today. Today you've got a double act, myself and Bart. And I suffered from a bit of jet lag last night. I really struggled to get to sleep. At about 2 o'clock I woke up and I was awake until about 6. And I got thinking about all of the double acts in the world. And you've got many across many different professions. If you think about the investment universe, you've got Warren Buffett and Charlie Munger, a very powerful double act. In the field of technology, you've got Steve Jobs and Wozniak behind Apple. And in the world of entertainment, you've got many. You've got Laurel and Hardy, Abbott and Costello, Tel and Penner, and whenever I did my best to shut my eyes and go to sleep, and really willing myself to go to sleep, the one image that cropped into my mind time and time again was this. Now, I'm not sure what it is about Bart and I that made me think about it, but the one thing I can assure you is that Bart and I will not be as hilarious as the 1988 classic film Twins. But what we do hope to do is share some interesting insights. I'm going to be talking about the strategic case for gold, why it makes sense for investors, no matter what the market conditions are, for them to be holding an element of gold in their portfolio. And Bart will be talking a bit more about the current market and macro conditions and the role of gold in today's world. I'm going to level with you guys. I sometimes find it a bit strange coming to a gold conference talking about gold to people who already get it. I mean, everyone in the audience already understands the investment case for gold in your own way. So I'm not going to lecture you on the investment case for gold as the World Gold Council says it. What I really want to do is just share a story with you guys, a story for how we communicate with institutional investors when we're articulating the investment case for gold. And what I hope is by doing that, that might give you guys some fresh ideas about how you can engage with your clients, potentially give you some ideas around how you can embellish your marketing materials, and just make you aware of some of the resources the World Gold Council has, which can hopefully support you and your client engagement. So when it comes to engaging with institutional investors, we don't launch into a wonderful monologue articulating the features and benefits of gold and why everyone should have a bit of gold. If we did that from the get-go, people would put up the barriers, they wouldn't listen to us, we wouldn't have the space to have a conversation with them. Instead, we first put ourselves in the position of the investor, of the portfolio manager. We really try to understand what are the challenges that they face. And through the years of engaging with these guys, the challenges they face typically fall into one or more of 4 buckets, which could be return generation, market volatility, illiquidity risk, or capital preservation. And then once we understand the challenges they face, where they're coming from, we can then talk about the role that gold can play in helping address some of these issues. And the great thing about gold is gold can play an important role in addressing each and every one of these issues. And I want to just rattle through each one very quickly to give you a few ideas about how gold can address those issues. So firstly, returns. It's a common misconception that gold doesn't offer a return, it doesn't offer a yield. That's a barrier that we've heard chucked back to us time and time again by many institutional investors. But if you look at it through total returns and compare the return of gold to that of many major mainstream asset classes, you can see gold's returns are comparable to equities, bonds, commodities. And in this chart, we'll look at it in 3 distinct buckets, from 1971 over the past 20 years and then over the past 10 years. And you can see since 1971 and over the past 20 years, gold performed very, very favorably in comparison to other mainstream asset classes. And even over the past decade, which I'm sure many of you will agree has been pretty miserable in parts, gold still performed very well in comparison to commodities and bonds. So returns. Gold does offer returns, and that often grabs investors' attention. The late, great Harry Markowitz described diversification as the only free lunch an investor can get. And investors can obtain diversification by putting assets in their portfolio that move in different directions at different points in time. Technical jargon is having a degree of low correlation. And different assets can play different roles in a portfolio. And the great thing about gold is an absolutely fantastic portfolio diversifier. This chart looks at the correlation of gold with the S&P 500 under different scenarios. In the middle, you're looking at the S&P 500 and gold during normal market conditions. And you can see it's got a near zero correlation, just beneath zero. The top gold bar has a look at gold when you've got a really booming equity market. And what this reveals is that gold has a positive correlation. So when equity markets are rising, gold is rising too. And then the bottom bar is the story that we all know and love. Gold is a safe haven asset. When equity markets are tumbling, when times are tough, gold typically holds its value, or if not holding it, increases its value. So gold offers the right type of correlation, which makes it an excellent tool for portfolio diversification. The third feature we talk about is liquidity. Investors are very keen to understand the liquidity profile of gold. Are they able to get in and out of the asset in decent chunks without moving the price, without having higher bid-ask spreads? And we heard the conversation yesterday where people were talking about exchanges and OTC trading, and we know that gold is a deep and liquid market. And in this chart, we have a look at the liquidity of gold in comparison to some other mainstream asset classes. And you can see that gold is more liquid than some major bond markets, UK gilts, German bonds, and is incomparable to the euro-yen currency cross. So gold does have a liquidity there, which makes it possible for large-scale institutional investors to access the market. This conversation comes into its own when you're speaking to investors who hold alternatives in their portfolio. Now, as you all know, alternative assets include real estate, include private equity, include unlisted firms, and typically alternative assets have a lower degree of liquidity. So if a fund manager, if a portfolio manager holds illiquid or relatively illiquid assets in their portfolio, gold can be an excellent complement through its liquidity profile. So those are the three simple features. You've got returns, you've got diversification, you've got liquidity. The final thing we do when speaking to investors is pull it all together in a snazzy bit of portfolio optimization. We have a look at a portfolio, run some calculations, and then work out how it would look if we included gold in that portfolio. And we've done that in this instance with a typical US pension fund. To explain the chart, on the left-hand y-axis, you've got the risk-adjusted return of the portfolio. Along the x-axis, you've got the asset mix with near the cross. You've got the average portfolio of the pension fund. And then we go through an incremental addition of gold, adding 2%, increasing that to 5%, increasing that to 10%. And you can see that with each and every addition, we're boosting the risk-adjusted return of the pension fund. And we find having those conversations around those four aspects with institutional investors is a great way to open the door to end up having a more detailed conversation. And if people hadn't thought about gold before, after discussing this with them, they typically want to hear more. So once we've talked about this, people then ask us a simple question. It's the simple questions that are sometimes the hardest. They ask us why. Why does gold behave the way it behaves? Why does gold have these fantastic portfolio attributes? When you read the newspapers, when you talk about gold's price in the short term, more often than not, you'll be talking about it in the context of macroeconomic variables, whether that's real interest rates or the US dollar, and very, very clearly important variables to be considered. But when you think about the strategic case for gold, the drivers I've discussed so far are more deeply rooted in the fundamentals of the market. And I'll touch upon that briefly now. So if you think about demand, you've got a large portion of demand that's closely linked with economic expansion. As people become wealthier, they'll typically want to buy more jewelry or buy more gold containing technology, such as your smartphones in your phones. Smartphones in your pockets. And that speaks to a slide I talked about earlier on, the positive correlation between gold and a booming stock market. People are feeling wealthier, they'll buy more gold because they've got greater cash, more disposable income. You've also got a decent chunk of demand, around 30%, which is investment, and that's more likely to be driven by uncertainty. And this is the safe haven story that everyone knows and loves around gold. When there's greater uncertainty, vulnerability in the markets, people flock to gold for its safe haven properties. And finally, you've got central banks, and central bank demand is more likely to dance to its own tune rather than respond to the vagaries of the economic conditions of the day. Gold acquisition from central banks, as my colleague Shao Kai here today will, I'm sure, be more than happy talking to people about, is more closely linked to policy-related decisions and are far more strategic in their outlook. So you've got that diversity of demand and that dual nature of demand being supported by economic expansion and a large portion of demand being supported by uncertainty, which really underpins gold as an asset class. Gold's also a global market. We all know this. But why is this important from the investment case? Well, it's important from two angles. First, it means that gold is exposed to different business cycles in different countries at different points in time. And the second thing is that gold is exposed to different customs and different cultures. And if you think about how that manifests itself in terms of demand, you have demand peaking in the West around the holiday season. You have demand peaking in India around Diwali, and in China around Chinese New Year in January and February time. And that makes for a more diverse profile of demand over the course of the year. Finally, you've got well-diversified production. And this is important because, unlike some other precious metals, gold isn't necessarily subject to supply-side shocks. If you think about platinum, it's largely produced in South Africa and Russia, and any labour dispute in either of those markets, more likely South Africa, could have an impact on mine production and could have an impact on price. Gold doesn't suffer from those issues. So in summary, when I think about the investment case for gold, gold offers returns. It's excellent in terms of portfolio diversification. It's a deep and liquid market. It can enhance the risk-adjusted returns of portfolios. And those features are deeply wedded and embedded in the market through the fundamentals of supply and demand. Investor resources. So the final few points from me. A few years ago, we went out and spoke to investors to make sure we understood what the barriers were preventing them from investing in gold. And we spoke to some people who said they'd never invested in gold before. And we did a survey and said, well, why is that? Why haven't you invested in gold? And the most popular response that came back to us was a lack of data and a lack of insight, or it was just too hard to find the information because it was so disparate. So we took that as a challenge and went off and created Gold Hub, which we aim to, well, we hope, is a one-stop shop for gold investors looking to arm themselves with all the data and insight required to make an investment decision. I won't go into it in too much detail, but we do have a short video which will hopefully be able to talk you through the features.
The definitive source of gold data and insight. Gold Hub brings together key gold market data, tools and expert research in a comprehensive resource. Through the platform, you can build your own analyses with interactive charts and tools, helping you make informed investment decisions. One of Gold Hub's key features is the Portfolio Simulator tool, which enables investors to create and compare portfolios and analyze their historical performance. The tool allows you to add multiple asset classes from a wide range of options, with the most common classes pre-selected for your convenience. You can weight each asset class allocation to help you achieve a deeper understanding of how gold might complement your portfolio. The tool also features a host of other options to fully customize your portfolio's attributes. The Portfolio Simulator will then generate your results instantly in a comprehensive report, helping you to visualize the potential impact gold could have had on your portfolio. Gold Hub, the definitive source of gold data and insight.
So that's it from me. Hopefully that's been useful. Hopefully you recognize there are a few resources which might be valuable for you if you're thinking about your client engagement materials. One final disclaimer, I hope this disclaimer popped up on screen there, but a point of clarification in reference to an earlier slide. Bart and I most definitely are not twins, and I'll pass over to Bart now to take you through his presentation.
We may not be physical twins, but I think from a philosophical standpoint and how we see markets, we are indeed twins, though I may be the shorter, less handsome one, which, you know, at my age, I'm okay with it. There was a time where I apparently had hair. It's been so long, I don't really remember it, but my mom tells me that I'm still good looking, so I will defer to her and trust her. I thought I was going to take a little bit of a different take on asset allocation. You know, I've asked the question, why hasn't gold done better? Interest rates are pretty low. In real terms, they're negative across massive swath of fixed income assets. We are talking about a Federal Reserve that was never really going to get overly hawkish. Yet gold is, you know, to paraphrase, a dog. No one loves it, no one wants it, and no one has it in their portfolios. And it's a very interesting question why that is. I think there is a knowledge gap here, particularly because a lot of portfolio managers that I know are, they look 12 years old to me and they have their hair. You know, I despise them for having hair to begin with, and some of their views are interesting to say the least. They've never lived through a down cycle in anything, so they take things for granted that everything is going to be spectacular all the time. And these risk assets such as gold may be out of vague for that reason. But mostly this presentation and our journal article I have written for the Crucible here was to basically justify to the world why the hell was I so wrong. So really this is a treatise on explaining why I was wrong on my forecast, to basically give excuses for myself. And it came out to be a decent paper in the end. So the title of this presentation is Percolating Market Policy Risks Point to Weightier Gold Allocation. And when I refer to portfolios, I don't necessarily only mean portfolios held by pension funds or real money accounts that we often deal with, but I also consider foreign reserves to be part of that structure, and explain, I think at the end of it, we'll try to explain that why at some point we think that gold is going to do a lot better, because there will be a convergence of forces in the global economy, which include higher risk, somewhat lower dollar, volatility, and the fear of monetizing massive debts that we have acquired, both private and public. This could be a very, very interesting world down 20 years down the road. And I think, you know, before I start to get into my very cool charts, I will say that the world among respectable people is talking about the legitimacy of modern monetary theory. That makes me think of Weimar Republic and or other horrors on the monetary history side. I'm not going to go there too much, but that is something that if I'm a central bank, I may think of, because their holding of assets isn't for the next quarter. It is for maybe the next century. And I think those fundamental structures and developments are playing very, very large increasingly, at least among some of the massive pension funds and sovereign funds that we talk to. They're not only looking for the next quarter, they're looking for the next century and how the world will will be. Will we have a single reserve currency, maybe two? Will there be superpowers in conflict? What will happen to aging populations, and how do we service the potential paper that comes out of it? Let's recall, the United States is issuing $1 trillion of new securities every year, and that's probably not going to get better when the economy slows. And I pretty much gave away everything I said already, so I might as just well go. But we do have some time, and so long as I can figure this out, which I did, we'll go on. So, here is a situation where we have fairly low interest rates, negative in vast swaths of the world, and still not a lot of interest in gold. That started me to thinking in, is it really just fixed income, or do we need to look gold as it is represented in a broader portfolio, to something that you referred to? When we look at total returns, now I've started to acquire evidence that it's not really just what fixed income generates. It's really what portfolio, including a well-diversified portfolio with equities, does. And gold, being a zero-yielding asset, it's not like you get a coupon or anything. Yes, relative to fixed income, hasn't really been very expensive to hold. But when you look at the equity market during a period of uber easy monetary policy, in terms of private equity holdings, in terms of real estate, well, it is massively underperformed. So my hypothesis from this is, in order for gold to do well, the rest of the world must do a little less well. At least perhaps not in nominal terms, but in terms of risk-weighted possibilities. We're going to have to start believing that the world isn't a beautiful, secure place, that there are risks and rising volatility in the wings. I think it's too early for that now, but I think as we move into 2020, some of that is going to manifest. And, thank God for Mr. Trump. He's just he's just speeding up this whole evolution of risk, and I think helping gold out to somewhat. So as you see here, our indicators are showing that there is very little interest in gold in portfolios. We have a indicator called the Z-score, and of course the other one above in green is just the CFTC speculative positions, and there hasn't been a lot of appetite for gold. And gold, as you mentioned, this is data from 1980 from 1990 rather. It's negatively correlated to most equity markets, except the ones that are very heavy in gold and commodities. And of course that includes the TSX in Canada, which is very gold weighted, and the Australian and the Mexican. So there is legitimate reason to have gold in the portfolio. But that's probably not enough, because gold doesn't, from our analysis, shows that it has a symmetric behavior. It tends to behave asymmetrically. If there is an outright massive decline in equities, we've seen gold actually be positively correlated and getting hit almost as much as anything else. We explain that by basically saying that when there is a systemic issue, like we've seen in the aftermath of the Great Recession, then there is a liquidity problem. Broadly, equities are collapsing. We're not sure what the rules will ultimately mean. And gold suffered along with everything else. And many people were asking us, how is gold a safe haven when it's getting hit? Well, my response was that, it might go down, but it's not going to go down to zero. And then upon further investigation, we found that when margin calls were made, people couldn't simply sell certain exotics or structured products, mainly because they lost all value. There was no market for them because they really just existed in our computers in the form of options and other fancy synthetics. Gold was sold quite often because it was liquid and you could backstop your portfolio. Well, there is value to that. It essentially means you save your other assets from utter collapse. You don't sell them at zero because you have a hedge asset that has liquidity and has intrinsic value and is nobody's liability. And that was, I think, very good information. So from that on, we are thinking that we are starting to see even central banks reflect that. This just is a representation of showing a movement away from US dollars. Gold is benefiting, and I'll touch on that a little bit more. And there is plenty of room to go. I think the issue over the next 10, 20 years is going to be, is it prudent to have treasuries in your portfolio for the next 20, 30 years when they are printing $1 trillion plus at a time where we're having superb economic growth? How is that funded? What happens if we have progressives in the Democratic Party in the United States take over and want to equalize wealth by borrowed money? How does that work out? I'm not pretending to say I know how that's going to work out. I have my fears and biases, but if I'm a central bank holding hundreds and hundreds of billions in USD, I may want to diversify, and might want to diversify into an asset that's not a liability of people with the ability to print money. And certainly if I'm a pension fund with 180, 200, 300 billion dollars and I have 30-year obligations, I have the same problem as of a central bank. I need some assets that at least will hold their value. And I think once we start seeing the environment shift a little, where equities aren't returning as much as they are, volatility grows, and the economy slows, our prediction is sometime in 2020, gold should start coming back into vogue. So why hasn't gold performed as well as we had hoped? In spite of a flat yield curve, inverted now, I think that ultimately will be great for gold. It will be, as far as we're concerned, the investment flows that drive it. There is so much gold in inventory. What really matters is not how much miners produce. I think that's irrelevant. The key to this whole thing is, on the increment, how much gold can flow from inventory into the physical market. And that is very much an interest rate story. It has to do with the flatness of the shape of the curve and the opportunity cost and the cost of funding. Typically, bankers are just generally great people, as you may well know. But, the whole point of it is to make money. If the curve makes it conducive to move gold from storage or vaults into the world because the yield curve makes it profitable, that's exactly what we'll do. And therefore, what really will matter to me is, as an indicator, is where real interest rates and carry are going. I think as we move into 2020, we're starting to see some slowing of the US economy. The most recent manifestation was US payroll numbers, which were sharply below expectations in the 70s. We've seen durable good orders slowing down, and we have this possibly a very aggressive trade war between China and the United States that may hasten the slowdown. And that, to me, will mean that inflation, which is already low, will force central banks to create an environment with significantly lower real interest rates. So gold isn't necessarily responding to inflation per se, but it is responding to how monetary policy players handle inflation or disinflation. And at a time where inflation is already low, macro environment is weakening, debts are sky high. I'm betting that real interest rates are going to have to be much lower than anybody expected to fund this economy and prevent a significant collapse. And before I go, I thought I'd show you the pictorial of what debt levels are looking at. So as an indicator, my canary in the coal mine here is particularly US debt on the corporate side, which was massively funded by zero interest rates. To me, that's the big incremental. Federal governments can print and they can tax, so it's a problem, but that's a longer term problem. My question is going to be, how do you fund that paper when your revenues slow down? I suspect you're going to have to come to your central bank, maybe indirectly, not so much to the window, and beg for relief on interest rates. And I think that will be, some sort of quasi-monetization and uber low real interest rates, which will drive those curves in a way that will attract metal into inventory, as opposed to move them out, and we'll be hoarding that hedge. And I think that will get me my 1400, 1450 price towards the second half of next year. I think I'll end here, and we'll take some questions, or if not, we'll just chat among ourselves.
So I think questions may appear here on Slido. If you have any questions, please just add them to the system. But whilst we're waiting for that to load up and for the audience to kind of pepper us with questions, I know that you're quite close to the central bank space. We've seen great momentum in central bank buy-in in 2018 and in the start of this year. What's your sense of how it's going to continue? Do you think we'll be seeing another good year for central bank demand in 2019?
I certainly think so. Of course, as everyone here I'm sure knows, we've seen the best central bank buying in some 5 decades last year. This year is looking fairly robust as well. China, again, accumulated more metal since November. The Russians are continuing to buy metal there. So I think it could even be a better year than last year. I think there are some very good reasons here. One, global trade is waning and probably shifting away from the US sphere. That's number one. Number two, what I've already spoke about, there's this concern that there might be de facto monetization, and for the long run, central banks are thinking about that. But I think there's one more thing. They're making money on it. I know they're sitting here in our audience. Our desk is trading quite actively with some of the central banks, and when I talk to them, even the ones that don't have any are asking a lot more questions on gold and gold acquisitions than I've heard in a very long time. So I think, yes, I think they will be buying more gold. They're afraid that the US dollar may not be as powerful as it is today.
And we've got a good question, but before I answer that, just an observation on your presentation. When you talked about negative rates, the impact that they're having on the world, and kind of there being maybe a lack of response in the gold markets. I think one area where we have seen a response is in the European ETF market. As many of you in the audience will know, negative rates are pernicious in Europe at the moment. 10-year bonds have been trading negatively for a few months now. And we published a nice chart a while ago, and it's a sea of red. And no surprise, we've seen gold-backed ETFs in Europe hit record highs. The gap between AUM in Europe and North America has narrowed to its narrowest level
on record. So I think when it comes to the European investors, they're particularly aware and sensitive to the negative rates they're seeing in their market.
Yes, and I fully agree with you. That certainly has been the case, but it hasn't been enough. The fast money that we track, the CFTC, the CTA people, only very recently started to increase positions. Last week's data was very robust. I think it was a 38% increase in long exposure. A lot of short covering, significant amount of new longs. But I suspect as we move into the into the second part of the year, that will likely slow down. And again, I blame equities here. So we have lower interest rates, but at least in the initial phase of these so-called insurance rate cuts, which I think are coming in the United States, equity markets tend to accelerate quite strongly. So we might get another few quarters of very robust equities, which I think will crowd out gold. So it is true, but I think it is a portfolio approach. What are you getting when you include equities into the frame? And as you know, we haven't really, as an industry, talked about gold relative to total returns in a well-diversified portfolio. We have always focused on interest rates alone, and that's probably an error.
Yeah, I completely agree with you there. I think it's so important to talk about gold in the context of other asset classes when you're trying to make gold relevant to mainstream investors, because that's the way they think. They're thinking about their broad portfolio of assets, and I think it's incumbent on the industry to try to talk about it in those ways. So, just tackling the question in terms of return and diversification, wouldn't it be smarter to have a portfolio of precious metals rather than gold? I suppose one way to answer that would be to think about it in the context of diversification. And if you think about some of the precious metals, they're perhaps more heavily correlated with industrial uses. Platinum, silver, probably more closely aligned to the business cycle. So from a correlation perspective, they certainly wouldn't be better than just having purely gold in your portfolio. In terms of returns, well, platinum hasn't performed so well in recent years, so maybe that would have been a drag on portfolios and from a returns perspective. But just in terms of precious metals more generally, liquidity is a really key point, which for a large-scale institutional investor would mean that they're just not relevant. The gold market's a $7.5 trillion gold market. Many of the other markets are measured in billions rather than trillions. So from a liquidity perspective, some of these other precious metals markets just won't be on the radar for institutional investors.
Yes, I fully agree. It would be tough for, let's say a $200 billion pension fund to get into palladium or rhodium. I mean, it would be a very nice return potentially, but it wouldn't move the needle for their total value. It would be much, much too small, and I'm sure their compliance and risk people wouldn't allow it because they couldn't get out of the position of any size. So gold, potentially silver. I personally have a bias towards silver. I like silver not only because it's shiny and tarnishes only a little, but I like the volatility of it. Typically, it's got double the vol of gold, and I suspect if we do get interest in gold, in a bullish gold environment or a bullish precious metals environment, silver tends to outperform. And prior to coming here, we did some analytics on the supply-demand side. And we've discovered that if some of our assumptions on the investment flows are correct, that market could very well turn to a modest deficits, which could be very interesting. Though you're right, it is an industrial metal, but it has these so-called monetary elements as well. And I think when gold does well, silver should probably outperform. But again, very tough to invest in silver if you're a large player. So it's more of a poor man's gold.
There's a neat question here. How would you evaluate the impact of trade war between US and China on gold? Do you want to pick that up, Bart?
Well, it hasn't been good, right? Because the key issue here was that the US dollar was seen as a safe haven. The RMB has weakened, not quite to 7, but I think it's a problem anytime the US dollar strengthens relative to our currency, and we haven't, certainly the data we look at, we haven't seen significant evidence to show that there has been an acceleration. In fact, I think several things happen here. Economic growth expectations have been downgraded, trade has been downgraded. We've seen a more aggressive action on the part of People's Bank to keep money within the country, and the currency all have been not all that positive for gold. From the investment side and jewelry and just all around. I don't know if that fits in what you're thinking as well, Alistair.
Yeah, I mean, that chimes completely with the way that we've been thinking about it. Do we have any views on euro debt levels, Italy in particular, versus US corporate debt? So my perspective on euro debt levels and Europe in a whole, it's, I mean, Europe faces some real structural challenges. Since its inception, it's not a perfect monetary union, and that will continually pose problems. And it's currently manifesting itself in Italy and their debt issue. Previously, we've seen issues with Greece, Portugal, Ireland. And this is one of the reasons why the European gold market is relatively healthy. I talked about the European ETF flows earlier on and how European ETF AUM has hit record highs. But you've also got very strong physical markets. Admittedly, they're probably a little bit softer than they were 3 years ago, but the European bar and coin market is multiples of what it was pre-2008. So certainly the Italian debt situation, the troubles that euros suffer and the euro area suffers supporting demand in that market. But it's probably not sufficient at this point to having a big impact on the gold price.
Well, let's hope it doesn't get any more sufficient than it is, because that would certainly spell trouble for the European economies. And if you do have an insolvency issue within that sovereign market, the question is going to be, can the ECB, from a legislative point of view, can they step up like the Federal Reserve has stepped up and monetize the problem? In the end, the ECB would have to put their big boy pants on and act like a real central bank, ignore some of the Maastricht Treaty restrictions, and monetize. That's ultimately the function of a central bank. They are the lenders of last resort, whether it be to banks or governments. At some point, if this becomes a crisis, we'll have to take that paper, buy it, and finish it off. If they don't, gold will likely do very well, but I'm not sure I want to live in that environment when it does.
So there's a question here. I was talking about institutional investors, and that's a key focus of the World Gold Council. And whether that will move the price rather than retail investors or jewelry. And then similarly, a question about central bank purchases, 650 tons last year, and the price action's been relatively disappointing. And probably opens the door for me to just talk a little bit about how we think about price and the drivers of price. We broadly think of there as being 4 drivers of price and the gold market over the long term. I've touched upon a few of them, but firstly you've got the economy and economic expansion, and that's people becoming wealthier over the long term, having more cash in their pockets, being able to buy more jewelry, being able to buy more technology which contain gold, and the econometric analysis we've done at the World Gold Council indicates that's a very important driver of prices over the long term. Then you've got opportunity cost. Opportunity cost, as Bart's talked about, is focused on real interest rates and the probably more short to medium term drivers of the gold price. Then you've got uncertainty, and I've talked about how that's a very important factor in terms of influencing investment flows. And finally, you've got momentum. So when the price is rising or if the price is falling, you'll get people piling into the market accordingly. So those are the 4 drivers of the gold market and the gold price as we see them. And you can see how different elements of the market fit into each bucket. So we certainly don't purely think of we purely don't think of institutional investors as being the sole driver of the gold price. A healthy gold market requires all the composite parts to be performing over the long run for it to remain a relevant investment asset class. But I think if we think about short-term price drivers, there's no doubt that people like Bart to be looking at the data on COMEX, and that will be indicating more short-term institutional money.
Sure, we also track CTAs, which roughly represent 35% of all global trading, and I think as much as 80% of all trading is somehow touched by an algorithm. So that is something we track with our artificial intelligence algo, and you're right. That momentum is extremely important in how the gold market evolves, a lot more so than it was 5 years ago, certainly 10 years ago, it was nowhere near. When we follow these CTAs, we have a model that maximizes performance and creates, I like to call them imaginary portfolios, but what they are is they're structured portfolio, they're theoretical portfolios that are based on behavior. And what we see is these so-called trend followers can move prices significantly higher. Before the last rally from the 1280s to where we moved to 1340, that was in great part triggered by the fact that the CTA trigger level was achieved at 1287, I believe, and then we saw the systematics pile in. It was, we were shocked how predictable that was. Then the macro folks got in, and then the technicians, and of course we started seeing COMEX activity. There's a question here about the 650-ton purchase by central banks. That is a large number, but compared to the daily flows in the OTC market and the futures market, that's kind of peanuts still. So it's those investment flows, those fast flows that will move these markets around, at least in the short run. Longer term, probably fundamentals play a role, but day to day, it's what data we see and what the US dollar does, has been in our experience, drives the price the most.
Yeah. Okay, I think we're done, Bart. I think our slot is over. It's been a pleasure. Thank you very much. Some great questions, and I'm conscious we haven't answered all of them, but myself and Bart will be floating around, so you can grab us if you want to ask anything else. Thank you.
Thank you very much. How about we have a family photo for both of you? You can stand up, and we can take a quick photo.